Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, May 28th. There is an astonishing optimism out there across the global financial markets that is not backed fundamentally. But the FOMO, so the fear of missing out, is very strong right now before Nvidia reports earnings after the bell today. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the market mood is astonishingly great this week on the back of a global decline in sovereign yields triggered by the Japanese government's will to adjust the size of its bond issuance after a selloff in long maturity bonds in Japan sent the 30 and 40-year yields in Japan to all-time high levels earlier this month. But that selloff was actually due to the growing concerns that the Japanese government will not be able to cover its massive budget deficits, and the yields are higher this morning, hinting that the volatility in the Japanese sovereign markets continues. Nevertheless, the rally in the Japanese bonds yesterday helped pulling the US 30-year yield below the 5% psychological mark, and that optimism from the falling sovereign yields was also completed by a better than expected durable goods orders data yesterday from the US, and also by a surprise rebound in US consumer confidence in May. In fact, the Conference Board's confidence gauge posted the biggest monthly gain in 4 years, and it exceeded all analysts' estimates thanks to the temporary trade truce between the China and the United States announced a bit earlier this month, and inflation expectations also fell by most since middle of 2022, apparently on lower gas prices. But the sentiment gauge obviously does not cover the fresh 50% tariff threats to American imports of European products, the uncertain and unilaterally changing trade negotiation deadlines, and also the warnings from companies like Walmart, for example, that warn that they will be reflecting the price increases from these tariffs in the broad range of their products. And also note that this on and off tariffs and this on and off tariff negotiations, uncertainty and unknown concretely disrupt the global supply chains by creating unnecessary tension on port activities, which are already under pressure, mind you, in major European ports due to labor shortages and the shallow water levels in the Rhine River. So all that is adding up, and an index showing shipping costs started to rise again after a decline from the pandemic peak levels, and that is not good news for consumer prices. So to me, this 2% rally that we saw in the S&P 500 yesterday seems exaggerated. And the futures are slightly in the red this morning at the time I'm talking here. Although the US dollar actually rebounded at yesterday's trading session from the lowest level since April this year, looks still better, but against some majors. The Eurodollar is testing the 130 mark at the time of talking here. Cable slipped below the 135 psychological level, while the dollar yen approaches the 145 level this morning. Now note that the fundamental reasons that weigh on the US dollar, which are the trade tensions and the swelling debt worries for the US, remain intact, and that means that the recent rebound that we see in the US dollar right now is unlikely to be a sustainable shift in appetite for the US dollar. Now, zooming into the Eurozone. The flash CPI update from France yesterday actually confirmed easing price pressures in May in the French economy. The figures actually came in soft, and they came in softer than expected. The French inflation actually dropped to the lowest levels in 5 years, and Spanish, Italian and German CPI updates that are due later this Friday are also expected to confirm easing price pressures after last month's surprise uptick in the Eurozone inflation levels. In fact, the biggest economies across the Eurozone are expected to print CPI figures below the European Central Bank's 2% policy target for the first time in 8 months. And the softening inflation numbers are obviously supportive of the dovish European Central Bank expectations and should, in theory, in this context of rising government spending from the European governments, back the European growth expectations and hence support the Euro's year-to-date rally. So here support is seen near the 112.12 level against the US dollar, which is the minor 23.6% Fibonacci retracement on the year-to-date rally. Then the 50-day moving average that acted as a clear support to the April to May retreat in the euro dollar, and that currently stands near the 111.80 level, and the major support is seen near the 110.25 mark, which is the major 38.2% Fibonacci retracement that should, in theory, distinguish between the year-to-date rally in the euro dollar and a medium-term bearish reversal. The outlook is still positive. Now, across the channel, the news are not quite the same. The latest data from the United Kingdom actually showed that food prices in the UK rose to the highest levels this year due to government's budget measures that fuel costs for the retailers. So that's a rise that's expected and factored in the Bank of England expectations. But there is still a growing number of analysts and politicians out there who are criticizing the Bank of England for having fallen behind the curve in its monetary policy easing and warn of economic trouble in the months ahead for the UK. But whatever the Bank of England expectations are, the dollar's trajectory matters more for cable's direction than the British fundamentals at the moment. So we could see cable move above the 135 level again if the selling pressure in US dollar returns. Elsewhere, the Reserve Bank of New Zealand lowered its interest rate by 25 basis points today as expected and projected further rate cuts due to downside risk that the global trade war poses on New Zealand's export sector and broader domestic growth outlook. The Kiwi was little changed against the US dollar this morning. The Aussie dollar, on the other hand, slipped below its 200-day moving average, and that on the back of a broad-based US dollar rebound that we see across the board today. And note that the Chinese economic weakness worries will likely cap the upside potential of the Aussie in this environment of economic uncertainty. Now, moving to China, the Chinese equities remain under pressure. Disappointing results from PDD yesterday sent the stock price more than 13% lower on Nasdaq at yesterday's trading session. The first quarter revenue rose slightly, but the profit nearly halved as the firm recently lost its de minimis privilege for small packages that it sends to the United States. And also note that other Western countries are also set to consider taxing these low-value imports to counter the aggressive competition from the Chinese platform. That's obviously impossible, but by far impossible to match in Western economies and by Western rivals. So the company's CEO Li Chen said that they should invest decisively to support consumers and merchants, but that the profitability of the company will remain under pressure for a considerable period of time. Ouch. That hurt. Now, zooming out, Nasdaq's Golden Dragon China Index spent a third trading session below its 50 and 100-day moving average levels, hinting at waning appetite for the Chinese stocks. But I still like the Chinese technology stocks, mind you, and I like them better at cheaper prices. But that's just me. Now, in the United States, it's Nvidia earnings day today. The company is expected to announce $43.2 billion US dollar sales in the first quarter with a net income above the $20 billion US dollar mark. The latest Middle East deals will likely boost their revenue forecast for the months ahead and tame the impact of export restrictions toward China. And in this context, AMD was upgraded yesterday to hold at HSBC thanks to the AI deals with the Saudi Arabia as well. Anyway, back to Nvidia. Strategists at BBVA think that encouraging earnings from Nvidia today could further boost the US equity rally as investors have about $7 trillion US parked in cash funds They say that they would like to spend in equities, and options markets suggest that the stock price will move more than 7% on either direction, depending on whether investors like what they see or not, and that could also have implications for broader market sentiment. So the earnings are due after the bell. Good luck, everyone. But until then, this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow after the Nvidia earnings. And until then, good day trading.